So today we're going to talk about key level. There's a lot of different tools can tell you where's the key level, support and resistance or previous high, previous stay open. So the simple way to put it is just like the market will react on that certain level. And doesn't mean the market is definitely going to reverse or break in that level. You still have to take a lot of different things into consideration. So the market is only going to do one of the three things on that key level. They either break the level, or they're going to hold and reverse, or they're just going to consolidate and just like around that level. So as long as we understand that, then we can just like build our story around it. And so I will talk a little bit more about what tools and how to use those tools to identify and use those key level. And yeah, so let's find a place to kind of sit down and we can talk about why the market going to draw towards those key level. So with that understanding, we can really make the best out of it. So yeah, so let's find a place to sit down. Okay, so yeah, finally find a place to sit down. So let's talk about like why does the price going to just like attract to those level, and just kind of the basic logic behind it. So basically, just like the reason why the market will favor certain price is because liquidity. So liquidity is basically just like how many people place order on that level. Like as long as there's a lot of people interested in those level, then they will be the high liquidity area. Because the big institution cannot just place order in a random place, because if they do, they're going to move the price, and they don't want to do that. So they want to just like place their order in the high liquidity level. So just like when they sell their order, people will buy their order right away. So easier for the institution will get better price in those level. But on the other hand, just like the low liquidity level will also draw the market towards a certain level. It's because those levels usually is easy to break and easy to get to. So that's the two completely different logic behind the liquidity and why the market will draw towards those levels. And so to put in a simple term, it's just like because the market will draw to the price that a lot of people place order, or the market will draw the price that like nobody place order. Okay, so yeah, so now we understand what's the key level and why the key level will draw the attention of the market. So when we get home, we can talk about like how to identify those key levels. So I'm going to introduce you some of the tools, and it's easier for you to spot those key level and how we can use those level to better our trading. So yeah, so let's just go home. Okay, so let's talk about like how can we identify the key level and how to use it. So there's a lot of tools out there you can use it to identify key level. So today I'm going to talk about one of the way to identify key level. So the way we're going to talk about today is use the open, close, and high and low from the previous day as a key level. So let's just go get on the screen and we can talk about that. So you might wonder why we use the previous day's open, close, and high and low as our guide. And because if you observe on the chart, you can notice just like if the market was trending, the market will go up a little bit, and the market will come down, break the open, and stay down, and the break previous low, and it should go lower. So you can see just like if we can identify those levels, just like, oh, the market trying to break the low of the previous day, and there's a chance the market will just continue going up for 1 or 2 days. And so you can see just like it doesn't really work when the market is in consolidation and just like what we've been experiencing for the past couple of days. But when the market was trending, and it's rarely the market will break the previous day high. So if the market is trending down, it's not likely the market will break the previous day's high and then go lower. So we obviously we will see some exception, here and there, and but mostly just like you can see the market go down and the previous high has never been break, and this market just keep going down. And same thing with when the market going up, previous day's low is never been break, and so it's just the market just keep going up. So let's just go down to the 5-minute chart. So we draw the open, so this is a green line, and the high of the day, so it's not too far away from the open, but we can still use that. And the low of the day and the close. Today's close is tomorrow's open, and so we use that opening price as a guide for the beginning. So when you can see the market was first consolidate, and then the market was get on top of the open, and today's open and go up, and go down again, test the open again. You can see this wick, and so the market have a little bit of volume and try to break the previous day's open, but fail and come down and try to go below the open and create the daily low. Now obviously just like at this point we don't really know that's the daily low for today, but the market create a wick, get back up to the daily open, and just like and then go all the way up to the previous day's open, and you can see just like the market finds some resistance here. And let's say just like with this example, the market come down and just like break below and close below. You didn't see these candles wick happen yet, and so you enter the trade below the daily open, and so your stop loss can be where you can set your stop loss above the daily open, but if you want more room, you can set it on the previous day's high. And so as you can see, just like when the market just like had created this wick, if you hold on to it, you say, oh, maybe just like it will create the lower high right here, but it didn't, and so you know just like if the market go ahead and break the previous day's high, and you will know you are wrong about the day. Just like you can just like get out and maybe just reassess. Maybe you can enter the trade just when the market tests the previous day's open. So let's just do it again with that thought process. The same thing we draw on the 15-minute chart. So it's not 5 minutes as earlier, it's the 15-minute chart. And so we have the open, high, and low, and the close, and so the close is today's open. The market consolidate a little bit, react to today's open and go up, try to break the open again but fail, and you can see the market just never come back to even close to the previous day's high. You might think, well, because the high end side is always 2020, just how do I know the market is going up? So I don't know the market is going up or down. I'm just saying just like those can be your key level. You need to create your bias. So let's say just like you don't know the market is going up, but you think the overall trend the market going down, and then you can just like plan your trade around that. So you have to see the market break the daily open and stay below, maybe just like break the previous day's low, and for you to confirm. But the market is never get below the daily open, and then that's a good indicator. The sign just like, well, maybe the market is going to close bullish instead of a bearish. Especially when you see on the higher time frame, you see 2 bars already bearish. Maybe the third bar will be bearish as well, and so you can just use that as your continuation. This is just one of the way to identify key level. But idea is just like when you set the key level, and you will say, okay, if the market was go below this key level, I'm going to go bearish, and that key level going to be your defensive line to say, hey, if the market break that line, then I will just get out of the trade because I was wrong. So that will prevent you to move your stop loss just because you think the market might retrace back and to break even or make you some profit. And so that's just something you can think about, and to kind of to know how you can use the key level as an entry, as an exit, or as a stop loss. So thank you so much for watching, and so I will talk to you next time. Bye bye.